loan officer might say something like, oh, call your student loan servicer, they can kick you into repayment. It's not that simple. Let me tell you why. It's important to understand, what do you want, what do you qualify for, and can you afford it? Those are the three things you need to ask yourself, right? What do you want? Can you qualify? Can you afford it? I mean, if you can't afford it, none of those other things matter, right? Today's video is about how the CARES Act has negatively impacted the debt to income calculation on student loans. And I'm going to talk about how it's negatively impacted it, but I'm also going to talk about what you can do as a student loan borrower to combat this issue, and how we here at Loan Sense can support you on that journey, and how we can help you get out of the debacle that has happened. And let me talk about what that means, debacle. Look, the Student Loan Department of Education, the Department of Ed that oversees student loans, does not talk to the regulatory bodies that mandate mortgage credit rules. Therefore, everything is a gigantic mess, because the CARES Act was meant to benefit student loan borrowers, but in turn hurt them when they want to go buy a house and compete in this low interest rate market. So let me teach you what you could do to combat this. First and foremost, if you're a student loan borrower, they put our payments into pause until September of 2021, which is this year, right? Since payments are paused, loan officers are counting our payments that are deferred as either 1% or 0.5% of our principal payment towards the debt to income calculation. 1% means, let's say you owe $100,000 of student loan debt. 1% is $1,000 now counts towards your debt to income. For a lot of people, getting $1,000 counted towards their debt to income is simply too high, and therefore they can't afford much home as a result, right? If there are some programs that count 0.5, I'm not going to go into all those details. All I'm going to say is this. If whatever your loan officer is counting is too high, and they're saying, hey, you don't qualify for mortgage, or you qualify too little because of your student debt, what you do is, we need to get you kicked into repayment. But your loan officer might say something like, oh, call your student loan servicer, they can kick you into repayment. It's not that simple. Let me tell you why. It's not about calling your servicer and getting kicked into repayment. It's about optimizing the best proof of income to lower your payment as much as possible, to get the lowest payment, to get the least counted towards your debt in the debt to income calculation. And let me talk really briefly about the debt to income calculation. All your monthly debt amounts divided by your income is what's called debt to income. You want that debt to income ratio to be as low as possible before they include the mortgage payment, because dollar for dollar, the more debt you have, the less home you can afford, okay? $1,000 of debt equates to, $50,000 of home affordability. $1 of debt counts for a much higher amount of home affordability you're foregoing, so you really want to lower your debt as much as possible. Okay, it's important to get the lowest proof of income, the lowest proof of income you have, to certify the lowest student loan repayment amount as possible, to get the lowest debt to income as possible, so that you can afford more house. Okay, I'm not trying to say max out your affordability. I'm not trying to say take every dime. I'm just trying to say, you want to qualify to actually be able to close, right? And some people, because of their student debt, they qualify for so little they can't even buy there. So it's important to understand, what do you want, what do you qualify for, and can you afford it? Those are the three things you need to ask yourself, right? What do you want? Can you qualify? Can you afford it? I mean, if you can't afford it, none of those other things matter, right? When I mean literally, can you afford it? I mean, try living in that budget, paying that amount, and seeing if you can survive for 2 months, okay? Or more, right? Recognizing that payments go up because of interest. Because of taxes and insurance, right? Those things tend to go up over time, especially as the value of your house increases. So FYI. So how Loan Sense helps is, instead of calling your loan servicer and trying to file into yourself, and like you might use the proof of income you used this year, which you use to try to qualify for your house, there are other proofs of income you can use from years prior, or other methods that can lower your payment legally. It's not illegal to do this. So we can lower that debt to income. So if you come to one of our advisors, we can strategize for you. Especially if you're married, make sure to watch my marriage video, because that may have even larger implications to how it affects your debt to income, okay, in terms of like your student loan payments, okay? Lastly, it's important that you get on a plan to close on the house, but then also know that you should have a long-term financial plan when it comes to managing your student loan debt. And we can't lose sight of that. And that plan may look different after you close, because whatever you do with your student loans after closing is a different scenario, right? You can close on the house, afford it, and then go to whatever your end goal payoff strategy is. Our loan officers can work with you. Our student loan advisors, I want to call them, they're not mortgage officers, or student loan advisors can work with you to build those plans and to get to your dream goals and results. So we can help you. We have all kinds of free tools, including a mortgage affordability tool and the only tool in the market that shows you how your student loan is impacted. We look forward to helping you. Check us out, myloansense.com. Thank you.